Welcome back, folks, to Investor Diaries. It's 2022, and we were researching on a fresh stock to bring to your attention. This is a new, young, and exciting company. But before we speak about that, if you haven't subscribed to our channel, please do so now by using the subscribe button below so that you do not miss out on any of our future upcoming content.
As Happy mentioned, we were researching for a fresh new stock to bring to your attention. And guess what came up in our research? A SaaS company that is based out of India and that recently filed for its IPO. Yes, we are talking about Freshworks, and we'll tell you all about this company in today's video.
Freshworks is an Indian-based company that is the equivalent of a customer experience company, Salesforce, meeting ServiceNow, or even Atlassian.
That's right, Happy. Freshworks spans three key markets, which is customer experience, sales and marketing, and system and service management. Freshworks is growing at a phenomenal pace, with large customers adopting its platform growing by 79% year over year in Q3.
Freshworks business is indeed growing, with Q4 2021 expected to grow by 38% year on year. Now, given the jump in revenues in Q2 2021 of 56% year on year, the business is clearly digesting some of that top line growth.
Nevertheless, it is highly likely that Freshworks is going to outperform its Q4 2021 growth rates. In the Magic Quadrant for CRM produced by Gartner, Freshworks is produced firmly in the visionaries category. Although it has a long way to go compared to market leaders like Salesforce and Microsoft, it is fair to say that Freshworks is poised for dramatic growth in the coming years.
Now, throughout its S1 filing, there are countless references to the importance of delighting their customers. Freshworks is a product-led growth platform that's focused on its product portfolio to break down the IT silos, thereby unifying a customer experience and IT services management, a space that's fragmented, complicated, and expensive.
That's right, Happy. Freshworks believes that its product is intuitive, easy to set up, and easy to use. A product that is affordable and easy to buy. It's aimed at assisting users by providing tools for sales, marketing, customer support across multiple channels.
Freshworks essentially operates as a seat-based subscription platform. So in principle, this implies that the bigger the organizations grow, the bigger the revenues that Freshworks can derive from that particular customer or company or organization, leading to increased net dollar-based retention figures.
And for Q3 2021, the net dollar-based retention was 117%, down 100 basis points from 118% in Q2 2021. For Q3 2021, net dollar-based retention was 117%, down 100 points from 118% in Q2 of 2021. So it's fair to say that it was essentially flat.
So now let's look at the product portfolio. It's got three products. A, it's called Freshdesk for customer experience. B, it's called Freshservice for IT services management and employee engagement. And finally, it's got Freshsales for sales and marketing automation.
All right, now let's look at some of the catalysts that are in favor of Freshworks going forward. Number one, rate of large enterprise adoption. So Freshworks has seen strong adoption from large enterprises. And typically in SaaS world, they say you either grow fast or you die slow. So while it's important to discuss revenue growth rates, it's also important to understand the underlying drivers of revenue growth.
As you can see in the graphic, in December 2020, customers spending more than $50,000 on the platform were up 65% year on year. Then moving forward to Q2 2021, this figure jumped by a staggering 14% to 79% year on year. Thus, it appears that Freshworks is rapidly growing. Now, for Q3 2021, the pace of growth has once again increased by 79% year on year.
The next catalyst we want to talk about is profitability. The profitability profile of Freshworks is clearly enticing. Arguably, the best aspect of the business model has to be that since it is based out of Chennai, India, its cost basis is dramatically lower than other SaaS platforms. As you can see here, Freshworks has a non-GAAP gross margins of 83% for Q3 2021, which puts it in line of some of the other favorite high-margin cloud computing stocks such as Cloudflare or CrowdStrike.
What's more, as you can see in this graphic, it's translated into nearly break-even cash flows from operating activities.
Next catalyst is insider ownership. As you might know, companies with founder-led management teams where the founder holds a substantial amount of stock tend to outperform mercenary management teams which have little skin in the game.
On this front, not only is the roster of VCs impressive, but also the management holds a meaningful portion of the stock too. It thereby demonstrates that Freshworks platform resonates with large enterprises as well as smaller businesses.
Now, let's take a look at the financials. Shares of Freshworks sank 29.9% in November, according to data from S&P Global Market Intelligence. The SaaS stock lost ground after the company reported its first quarter results, and it continued to move much lower as the month progressed.
Freshworks published its Q1 results on the 2nd of November, posting sales and earnings for the period that came in ahead of market expectations. The company posted a non-GAAP adjusted loss of 4 cents on revenues of 96.61 million in the period, while the average analyst estimates had called in for a 10-cent loss on sales of $90.85 million.
Additionally, Freshworks sales rose 46% year over year in Q3.
Despite recording sales and earnings that topped the market expectations, the company saw its free cash flow slip to 4.2 million loss in the period, swinging from a positive free cash flow of 10.3 million in the prior year.
Freshworks also had a partial stock lockup expiration on November 4th, freeing insiders to sell some of their shares. That lockup expiration may have caused some extra selling pressure that helped send companies' share price lower as the month progressed.
In the meantime, investors weighed risks presented by rising treasury bond yields and the Omicron coronavirus variant and have become more cautious about growth-dependent tech plays such as Freshworks.
Freshworks stock continued to slide in December as well. The company's share price slid roughly 19% in the month of December. Okay, so what's Investor Diary's conclusion or recommendation? We believe, although the valuation is rich, at 13.4x forward sales, it is not as expensive as it appears, and certainly not as expensive when you compare it with its peers in the SaaS space. Freshworks has a very interesting business model, and that is well positioned to capture the digital transformation that's already underway. Moreover, it is well placed to benefit from its low-cost, highly technical workforce. We at Investor Diaries believe that this stock has a lot of potential and a lot of upside and is a definite buy. The stock has taken a lot of beating in November and December periods, so it is especially attractive at these price levels.
Absolutely, Nidish. So you're getting a high growth play that's trading at a discount and that's got a huge future ahead of it. So from our perspective, go ahead and buy the stock. So that's a wrap, folks. Thank you for tuning in. Please let us know what you think about Freshworks stock, or if you want us to cover any other stock in the comment section below. And until next time, thank you so much.
Thanks, everyone.